place for sharp, focused market insights. You know, it really feels good to be back. We've just flown in from the Council of International Investigators, AGM, in Chicago. It was a fantastic experience, really energizing, sharing insights with top folks in financial intelligence, cross-border investigations, all of that. But now, yes, sights are firmly set back on the markets, and since it's Thursday, September 11th, 2025, well, it feels like a good time to shake off any, lingering jet lag from the week. Markets might not get jet lagged, but some traders definitely look like they could use a wake-up call. So let's skip the double espresso and jump straight into the data. We're breaking down the intelligence brief for Tuesday, September 10th.
Exactly. And our mission today is pretty clear. Dive into this intelligence. Pull out the really critical pieces of information, the nuggets. Think of this as your shortcut, to getting properly informed, connecting those dots, and giving you that wider context on what's actually moving things.
So you'll get a snapshot of global equities. We'll look at bonds, commodities, crypto, and then we'll zoom out a bit to the key economic events coming up, all distilled down. And this deep dive is powered by Nextsight. They're a global intelligence and investigations firm. They really go beyond just data collection. Their OSINT platform, Site Connect, turns raw signals into actual strategy. It lets clients tailor reports exactly to what they need, market analytics, complex investigations. Honestly, their work is on another level. You can learn more at www.next-site.com. Okay, so let's get into it. The executive summary for Tuesday, September 10th, what's the big picture? Global equities saw, modest gains overall. The S&P 500 hit another record close. It's a second straight one. 6,532.04. And the Nasdaq edged up slightly too to 21,886.06.
Right, but here's where it gets interesting, that positive feeling. It was largely because of softer U.S. producer price data. That definitely stoked hopes for a Fed rate cut, maybe sooner rather than later.
Oh, okay.
But, and this is key, the Dow Jones actually shed 0.48%.
There's not all indices moving together then.
No, not at all. And it suggests maybe some profit taking, but maybe also a bit of rotation out of those cyclical names. Some caution creeping in despite the tech optimism.
Interesting divergence. Okay, what about other assets? Treasuries.
Yields fell across the board. The 10-year Treasury yield slipped about 3.5 basis points down to 4.045%.
And oil. Heard there were tensions.
Yep. Oil prices were up between 1% and 3%.
Yeah.
Partly geopolitical risk, partly a small dip in inventories.
Okay, and gold. Still high.
Hovering near those record highs, $3,640.78 an ounce. And Bitcoin kept climbing, up around 2% to $114,101.92.
Wow, okay. So quite a mix there.
Definitely. And looking ahead, it sets the stage for a busy few days. Today, Thursday the 11th, we've got the U.S. CPI release, huge one.
Right.
And the European Central Bank's policy meeting, also today.
Two big ones on the same day.
Yeah, plus more U.S. data later this week. So the market mood is, let's say, cautiously constructive.
Cautiously constructive, I like that.
But very sensitive to surprises, especially on inflation or, if the ECB sounds more hawkish than expected, that could really change the tune.
Got it. Okay. Let's dive a bit deeper into equities then. You mentioned that divergence. U.S. large caps rallied, S&P record.
Yeah.
Driven by those cooling producer price hopes, gains led by healthcare, communication services, materials lagged a bit, and the Nasdaq saw a small rise despite, as you said, some rotation out of mega cap tech.
And that contrast with the Dow dipping 0.48% is really telling. It's not just random profit taking. It signals investors are getting choosier, maybe favoring sectors with more predictable growth over those tied tightly to the economic cycle, even when the overall market is up.
Makes sense. What about Europe?
Europe was more mixed. The SDX 600 dipped just a tiny bit, 0.05%. Tech weakness kind of canceled out retail gains there.
But Spain did well?
Yeah, Spain's IBEX jumped 1.25%. That was mostly thanks to Inditex, Zara's owner. They jumped 6.4% after strong results.
Okay. And you mentioned something about defense stocks in Europe.
Yes, absolutely. Defense stocks hit a record high, and that's a direct line, really, to the heightened geopolitical risk. Events in Eastern Europe, the drone incidents. It's a clear case of global events driving money into specific sectors perceived as benefiting, or maybe just safer.
A stark reminder of that connection. And Canada.
The TSX in Canada was up 0.4%, boosted by energy and materials, which makes sense given higher oil and copper prices on the day.
Right. And we should probably note the brief we're working from didn't have detailed real-time data for Asia or emerging markets readily available. So our focus is mainly developed markets today.
Correct.
Okay, let's pivot to rates and credit. Fixed income. This is where that producer price dip really made waves, right?
Absolutely. U.S. Treasury yields fell quite noticeably after that PPI report showed an unexpected dip of 0.1% month over month.
Unexpected is the key word there.
Definitely. And then you had a strong 10-year option on top of that, showing good demand for bonds.
So the 10-year yield dropped
Mhm.
about 3.5 basis points, you said, to 4.045%.
That's right. Now, what does that mean for the Fed? Well, futures markets are now pricing in about a 60% chance of a rate cut by December.
60%. Wasn't it higher recently?
It was. It was around 75% just last week. So it's a slight pullback in expectations, not abandoning the cut idea, but maybe pushing the timing out or seeing it as slightly less certain.
Okay, a recalibration. And credit spreads. Did they widen?
No, they stayed pretty steady, still quite tight, actually, near recent lows, which suggests investors are still comfortable taking on corporate credit risk despite a lot of new bonds being issued. That risk-on sentiment is holding for now.
Right, interesting. Now, something that hits home for a lot of listeners. Mortgage rates. You mentioned they plunged.
Plunged might be a strong word, but a significant drop, yes. The average U.S. 30-year fixed rate fell 15 basis points.
15 basis points. Down to
6.49%, which is the lowest we've seen since October 2024.
Wow, that's quite a move. Did it impact applications?
Immediately, mortgage applications jumped to 9.2% for the week.
9.2%, both refi and purchase.
Both. Refinancing applications were up over 12%, and purchase applications rose about 6.6%.
So lower rates are definitely unlocking some demand there.
Exactly. It suggests there's resilience in the U.S. housing market. Despite all the talk about affordability, when rates come down, people are ready to act. It's a positive sign.
Definitely a key point for the housing outlook. Okay, let's touch on foreign exchange. The dollar.
The U.S. dollar index ended the day pretty much flat, closed around 97.83. Seems like traders are caught between two opposing forces, the prospect of a U.S. rate cut, which would weaken the dollar,
Right.
and concerns about slower growth in the Eurozone, which could weaken the euro and relatively strengthen the dollar. So a bit of a balancing act.
The stalemate almost.
For now, yeah. There weren't any really strong new policy signals, so major currency pairs like euro-dollar, dollar-yen, they stayed in pretty tight ranges, kind of a holding pattern, waiting for the next big catalyst like the CPI or ECB meeting.
Gotcha. Okay, crypto assets. Bitcoin was up.
Yep, the CME CF benchmark reference rate for Bitcoin rose about 2%, took it to $114,101.92. Ether was up too, around $4,427.
So the assets themselves doing well, but what about crypto stocks?
That's the interesting part. They were mixed, and Reuters actually highlighted that shares of companies holding a lot of Bitcoin on their balance sheets, well, they've fallen quite sharply since June.
Fallen. Even as Bitcoin rises.
Yeah.
Why the disconnect?
Valuation concerns seem to be the main driver. Plus, these stocks are high beta, meaning they swing wildly. This gap between the asset price and the related stocks, it's a yellow flag. Could signal some caution is warranted, maybe broader speculative fatigue setting in within the equity side of crypto.
Something for investors in that space to watch closely then. All right, let's move to commodities and energy. Oil firmed up.
It did. WTI crude gained 1.7%, settling at $63.67 a barrel. Brent crude was up even more, 3.1%, to $67.49.
And the drivers were geopolitical.
Yeah, largely, yes. Poland reporting it shot down drones near the Ukraine border really focused minds. Plus, there was renewed talk about tougher enforcement of the G7 price cap on Russian oil. Both point towards potential supply constraints.
But inventories rose.
They did. That was the counterpoint. The U.S. EIA report showed commercial crude inventories up 3.9 million barrels, which usually pushes prices down.
So a real tug-of-war. Geopolitical supply fears versus inventory reality.
Exactly. Kept gains somewhat in check.
And natural gas.
Nat gas surged again, up to $3.10 per MMBtu. That extended a run that saw it gain 15% over just 5 days.
Wow. Why the surge there?
Mostly seasonal factors, warmer weather boosting demand combined with lower production levels recently.
Okay. And gold. Still the safe haven play.
Holding strong near that all-time high, $3,640.78 an ounce. The falling bond yields we talked about definitely help gold.
How so?
Lower yields mean the opportunity cost of holding gold, which pays no interest, goes down. Makes it relatively more attractive, especially when there's geopolitical uncertainty floating around.
Right. Makes sense. Okay, let's zoom out now. Trend and risk map time. Putting it all together.
Okay, so U.S. equities. Grinding higher, yes, but in a narrow range. Valuations look stretched. The S&P's 5-day gain was actually pretty modest, suggesting more of a neutral trend short term.
But Treasury yields are definitely trending lower.
Clearly drifting lower, yeah.
No.
The 10-year down about 12.5 basis points over 5 days. That shows real conviction growing about a Fed cut coming soon.
And credit spreads flat, suggesting low stress.
Low perceived stress, perhaps. Spreads are flat, which is good, but with yields so low, investors might be reaching for yield in riskier places. It doesn't necessarily mean all risk is gone.
Okay. And the VIX, the fear gauge.
That's the really interesting one. It fell 8% over the last 5 days, down to 15.04.
15. That seems
Huh?
low. Complacent.
That's exactly the word. It signals a real sense of market complacency right now.
So is the market maybe underpricing risks?
That's the big question, isn't it? A VIX around 15 often comes before a spike in volatility. With valuations stretched and volatility this low, the market could be quite vulnerable to a surprise. An upside inflation shock, a hawkish central bank. Either could trigger a pretty sharp reaction. It feels a bit like low volatility breeding future high volatility.
A potential ticking clock, then. Okay, let's look at the catalysts that could trigger something. What's on the horizon this week and next? Packed schedule, you said.
Absolutely packed. Today, Thursday, September 11th, the big U.S. CPI print. Everyone's waiting for this.
And the ECB meeting.
And the ECB meeting, yes. Markets expect headline CPI to moderate a bit, but any surprise there will move things. For the ECB, it's all about their guidance on policy, especially the balance sheet and their growth forecasts. That'll shape sentiment in Europe.
Then tomorrow, Friday the 12th.
More U.S. data. Producer price index and retail sales, both important for gauging inflation and consumer strength.
Followed by consumer sentiment on Saturday the 13th. Or is that Friday?
University of Michigan consumer sentiment usually comes out Friday, so September 13th.
Got it. Friday the 13th then.
And all these prints feed directly into Fed expectations ahead of their meeting next week, September 16th and 17th.
Where the odds of a cut are currently around 60%.
Around 60%, yeah. So this week's data could easily push that number up or down, causing ripples.
And energy reports.
EIA petroleum and natural gas reports also out today, the 11th. And then the OPEC monthly oil market report is next Wednesday, the 17th. Key for energy traders, especially with the current backdrop.
Okay, lots to watch. Let's translate this into operational takeaways for chief investment officers.
For CIOs, the absolute key is monitoring inflation surprises. An upside miss in CPI or PPI could slam the brakes on the bond rally and hit equity valuations hard. They need to be thinking about hedging strategies now before that FOMC meeting next week.
Okay, and for CFOs, treasury teams, that yield drop seems key.
Definitely. The 10-year yield at 4.045%. That might be a window to issue new debt or refinance existing debt opportunistically, especially with credit spreads still tight. Acting before the Fed meeting might be prudent.
Makes sense. What about risk managers looking at energy?
Energy exposure needs close watching. Oil prices are range-bound for now, but you've got inventory builds pushing down and geopolitics pushing up. That's two-sided risk. Companies with big fuel costs really need to review their hedging strategies before those EIA and OPEC reports land.
Right. And CIOs again on the crypto side, that disconnect you mentioned.
Yeah, keep an eye on potential spillover from crypto volatility. Bitcoin rose, fine, but the fact that stocks of companies holding lots of Bitcoin are underperforming, that suggests valuation worries, or maybe just speculative fatigue. CIOs should be aware this disconnect could signal broader shifts in risk appetite.
Good point. And finally, back to housing, that mortgage rate drop.
Yes, that sharp fall in rates and the jump in applications could definitely boost housing-related spending down the line. So CFOs and treasurers, especially in consumer-facing sectors like retail or home improvement, should watch for potential demand shifts. It could impact their planning for the next few quarters.
Okay, fantastic breakdown. So quite a tour through the latest financial intelligence for Tuesday, September 10th.
Yeah.
We've seen how U.S. inflation data, even just the producer prices, is really shaping Fed thinking. We saw how geopolitics is directly impacting oil and defense stocks. And it's surprising resilience in the housing market when rates dip.
Yeah, and it really brings up a question for you, the listener, doesn't it? When you see all these subtle shifts, these divergences, and you look at the packed calendar ahead, how could just one data point next week, maybe a surprise CPI number, ripple through your specific portfolio or your business strategy?
It's a critical question to ask.
It just underscores that in these markets, being informed isn't just nice to have, it's essential. This deep dive into the September 10th brief, delivered here on the 11th, really highlights how dynamic and interconnected everything is. And remember, if you're looking for intelligence that helps you stay ahead, check out Next Sight. They support executives, analysts, investigators globally with reliable, actionable insights. That wraps up this edition of The Deep Dive. Thanks so much for tuning in. We always appreciate hearing from you, so drop us a like, a share, or a comment. Let us know what you think. And may your Thursday be steadier than a bond trader after a perfectly in-line CPI report.